Welcome to the Daily Update, where I'll go over the action in the market for Thursday, February 22nd, and then we'll see how things look for Friday, February 23rd. We had a really strong day when it came to the Dow setting a new all-time high and the S&P 500 setting another new all-time high. There wasn't real broad participation in the upward move. Interest rates were virtually unchanged. The small caps were up, but not very much. The mid caps did a little bit better. So even though we're going up, we're still seeing this weakness that we have to be concerned with. Plus, we have what could be significant overhead resistance not too far above current prices. So we'll be watching that as well. Let's go back and talk about what happened. Right at the open, we had a huge gap higher open. We climbed above R3 right out of the gate at 5,045. This had to do with NVIDIA's earnings report. They came out right after the close in Wednesday's session. The market really liked that. The futures shot up. They stayed higher. Things got even more positive as we got closer to the open. We shot higher. And then instead of selling into strength, which you always want to keep an eye on when we see a big, huge gap to the upside, or you might see buying into weakness when we have a gap lower open, well, we just kept going right from there. As the day went on, we just kept going higher and higher. We went above R4 at 5,082, and we ended up closing above R4. So from a price perspective and just looking at the S&P itself, yeah, it looks pretty solid. We need to look under the surface at what's really going on. We were up 2.11% on above average volume, so we did pick up a little bit there. We're positive, but now with our usual suspects, we're looking a little bit overextended to the upside, but that could last for a while. We've spent most of 2024 being overextended to the upside or overbought. It wasn't necessarily about inflation, even though there was some Fed speak that came out that I'll go through, but interest rates really didn't change. It was mainly having a reaction to NVIDIA's earnings, and that bled through to some other areas in the market. Some comments that we can make. Both the S&P and the Dow set new all-time highs. NVIDIA's report, yeah, you could say it was well received. Not only did the stock go up really strong, but it did have an impact on certain areas of the market. The mega caps, the tech sector, and semiconductors, they were all up on the day because they're all related to NVIDIA. And just to make note of this, Amazon will be replacing Walgreens in the Dow on February 26th. They're making a shift there. So you might see some slight differences in how the Dow behaves. There was some Fed speak that came out, and there was a couple of quotes there that I'll go through, and I'll do that on the next slide. So now we're looking back at looking extreme positive with a little bit longer list of things in the short term, such as the Williams percent R, the CCI 14 and 20. They're both on the list. The stochastics, which has been there for a while now, but in the short term, we're looking more extreme positive. The standard deviations chart, because we rocketed up so much, we're looking quite overextended there. And the RSI, based on 9 periods, that also shot up. And then the boom indicator suggests that we're getting kind of far away from the 20-period moving average. In the intermediate term, also a little bit longer list. We have the rate of change going back 50 periods. The Arun indicator is now shot up and is looking extreme positive. We're keeping an eye on the oscillators. Yeah, they're still extreme positive, but they are not really shifting all that much. They're still having a tendency to drop below their moving averages. The Sean trend meter, the Chaikin oscillator, the percent B, we closed outside of the upper Bollinger Band. And the boom indicator showing that we're getting kind of far away from the 50-period moving average. And then this has been on the list for the last few days, the 10-period moving average or new high, new low study that we do on the S&P. And we're still looking extreme in the long term because we're getting pretty positive still with our 150 and 200-day simple moving averages. This is encouraging, though. The parabolic SAR has switched back to positive. So this is one kind of major improvement in the intermediate term where we had switched over negative. Now we're back over to positive. So that is good in and of itself, at least in my opinion. We're still dealing with this same scenario that it looks like the Fed is pretty much done raising rates and they're getting set to cut rates. Not too far in the distant future. We do have some statements to make about that. The dollar was up slightly, not a real big change there, and interest rates ended up being unchanged. We're at 4.33% for the 10-year yield. The idea that the market went up so fast and interest rates just kind of hung out where they were, not really encouraging there. And we still have the yield curves that we've been following that are inverted. We did slip back into extreme positive as far as sentiment. We ticked up from 70, where we had been positive, above 75, and we closed at 78. At least that's the last reading that I had here. And again, when we get above that 75 level, that's when it's looking like folks are getting a little too exuberant about things. But we really haven't changed much with our trend. The green line has turned back up with both the short and intermediate term ADX charts, but we're still dropping below the moving average. So that suggests a weakening trend, even though it's a positive trend, but we're above 20. So that suggests that it still is a trend. Of course, with the up day, our bias is positive. That's usually what I measure by bias, just up day, down day. And then momentum is the last 2, 3, 4, 5 days taken together. With the huge upward move, I've switched that back to positive as well. And this is the main part of the video that is subjective. I try to let the charts speak for themselves and really tell us what's actually happening. I try not to interject too much of my own personal opinion in areas. And when I do, I try to tell you that. But this is one of those areas where I just kind of take everything together and say, okay, the last number of days, we were seeing some weakness there, but with the solid update, we switched back to looking more positive. Here's some Fed speak that came out. Vice Chair Jefferson said that it will likely be appropriate to begin cutting rates later this year. Of course, the market's already been anticipating that, but to hear it from a Fed official just makes it a little more positive. But he also added that he's cautiously optimistic about the way inflation is evolving. So that's pretty positive, but it's not the chairperson. It's not Jerome Powell who's actually speaking here. And then Philadelphia Fed President Harker, who's not a voter, said that he believes that the Fed will may be in a position to see the Fed funds rate decrease this year, but cautions anyone looking for it right now and right away. So that's pushing it out a little bit, but at least they're talking about the idea of cutting the rates, and the market liked that. And I just kind of fed into this. But as I said, interest rates really didn't change in response to that all that much. We did get the weekly jobless claims. This is a little stronger than expected. We're seeing them go down. They were at 201,000. They had expected 216,000. Last week we had 213,000. The continuing claims are also dropping off a little bit from 1.826 million. Last time we had 1.88 million. And I don't have charts of this next one, the S&P Global U.S. Manufacturing PMI. It did come in above 50, so that shows some expansion economically, where it came in at 51.5. Last time it was at 50.7. The services PMI also above 50, so it's at 51.3. Last time it was at 52.5. Existing home sales were not a lot more than expected. They came in at 4 million. They had expected 3.99 million. Last time we had 3.88 million. Here's the chart of the weekly jobless claims where we did decline with the black line. That's the raw score. And we're starting to roll over now when we look at the 4-week moving average, suggesting that less people are filing for first-time unemployment. Here's the continuing claims that go on longer, where it also declined, but we're still going up with the moving average. If this continues to decline, eventually we would see the moving average roll over. Here's taking everything together where the red line, and it's really hard to see here, but I keep this other stuff on here just to give some context. The red line is the initial claims, the blue line are the continuing claims, and then we're going with the latest reading on the unemployment rate at 3.7%. A couple of charts, and these came out before the big move up in NVIDIA. We're a mega cap growth in tech. This is positioning. We're getting rather extreme. That's the place to be. And people often use their emotions to do things, and they chase what's already been successful. This is probably going to go up since a lot more folks probably got into NVIDIA and other stocks. And so we're getting near that kind of high extreme area where quite often this can mark some kind of a top. Also looking at the earnings sentiment, where the S&P 500, this is showing some improvement. They're getting more optimistic about the earnings for stocks in the S&P. We can compare that to the stock 600. That's the light blue area here. The topics, which is the gray area, and then emerging markets. And you can still see where the US is still way in the lead when it comes to earnings. Here's our intraday chart where we just blew above R1, R2. We started out just a little bit below R3 and then quickly went above that. And instead of pulling back and filling any kind of a gap, we just kept going higher. We ended up getting up to R4. We went above that. We topped out at just under, well, it was about the 50.95 level. And then we pulled back down to R4 and then closed up a little bit above that. Here's the intraday chart. We're right after the close on Wednesday. That's when we had the nice little run up going into Wednesday's close. Then the futures just built upon that, and they kept going up and up and up and up here. And then in the pre-market session, we saw it get stronger and stronger. That led over into the cash session, and we're not really seeing much change in the initial overnight session right now. This is one area we're not really seeing growth outperforming value, at least right now. We're both up, so that's positive, but the blue line's just a little bit above the red line. This is the intraday chart. This is the growth to value ratio. This is showing a little bit more of an improvement where we had been declining. Now we shot up, and so we are seeing some improvement when we look at just the S&P intraday. The end of day chart shows the growth was up 3.26%. That's monstrous. Where value was up, but it was only up 0.69%. We also saw an outperformance with the mid caps and kind of an outperformance here with the small caps, where value ended up being down for the small caps. So we're coming back up here when we look at our small cap growth to value ratio. Now this could continue to improve, but we're not really seeing much movement in the index right now. It had been shooting up and then pulling back. We did see a bounce here, but we want to see this continue if the small caps are going to improve. We also saw a little bit of a bounce after seeing some weakness with mid cap growth to value. And we also saw a bounce here, but we're not necessarily breaking out. We're setting all-time highs here with the S&P index, but we can't even surpass these previous highs with this ratio. Just a slight negative divergence there, and we want to see follow through from this. Looking at discretionary versus staples, yeah, we ticked up, but we're not really breaking out and showing any kind of massive improvement here. Here's our trend where we're still below the moving average, even though we're turning up. The green line is on top and we're above 40. That could be a concern. When any of these lines get above 40, that's usually extreme positive. And of course, the red line did come down. We're also above 40 with our short-term ADX, and we're also continuing to be below the moving average. And we came back up a little bit. The last 2 days have been slightly above average. So that's why you see the black line turning up, but we're still below the average level that we've been reading lately. Sentiment, we didn't really see much of a change at all in the Ulcer Index. With the up day, we did come down with the VIX, but we're still above that 15 level with the line chart and the bar chart. And with the down day, we did drop below the moving average with the VIX of the VIX, both with the bar chart and the line chart. So volatility did slacken off a bit there. We're still having a tendency to go higher with the VIX. This tries to measure the momentum over a longer period of time, where the MACD is continuing to go up, even though it rolled over slightly in Thursday's session. I don't have the updated charts. I waited and waited, and I just wanted to get recording this, so I don't have an update with these charts. This is also something that suggests that maybe the market isn't through with things yet. The VIX to S&P 500 correlation, it's continuing to give us a high reading, and it actually went up. And again, as I've been trying to point out here, if you look at the other times when I marked this, when we had a spike and then it started coming down, a lot of the time that is short to intermediate term negative for the market. And we've been seeing this reading now for a few days. We've been bouncing around here. At some point, this will get dealt with. And based on what has happened in the past, that's usually to the downside. And we did get the latest reading in yesterday's video of Investors Intelligence here, showing that folks are extreme positive. We got the latest reading from the American Association of Individual Investors, not extreme positive, but still looking positive nonetheless. Our advanced decline line studies, yeah, we're breaking out when we look at things based on price, but we haven't broken out here based on volume. A bit of a negative divergence. We're turning back up because we saw just an explosion of the new highs. When the S&P sets new all-time highs, that means stocks inside the S&P are going to be setting new highs as well. So we're looking a little more positive with our 5-period and 10-period. We're looking positive. We're above zero and advancing with the advanced decline ratio. The accumulation distribution has turned back up and is above the advancing moving average. We saw a nice little improvement with the Chaikin money flow. So this is looking positive when we just base things on price. We're starting to get a little extreme again with the Chaikin oscillator. But when you look at the advanced decline line studies, yeah, we were up with the common stock on the NYSE, but we haven't really broken out yet. We are breaking out with the S&P. We turned up, but we're not breaking out from this previous high with the mid caps. And we were pretty much flat when we look at the small caps. So we're not seeing an awful lot of across the board strength. Here's the daily chart where we shot back above the trend line. I have another breakout chart to show you this that makes it a little bit clearer. And on the bottom, we've now had 2 days in a row. One day was just slightly above average, where when Thursday session was above average. And we might have overdone it on a 1-day rate of change. When you get over a 2% move up, that means that you went up pretty far, pretty fast. Now there's a pretty big gap in here that at some point the market may decide to deal with. The Williams percent R is looking extreme positive, and the CCI 14 is extreme, as well as the CCI 20. We did go up with our 20-period, 50-period, and 200-period moving averages, and these are based just on the S&P itself, not necessarily internally what's happening. And we did see some improvement with the Force Index. We crossed back above the midpoint. If we stay above this, the midpoint will start to turn and go back up. We're extreme in the short term with the stochastics. We're turning up and not extreme in the intermediate term. We never came down from being extreme in the long term, and we are starting to turn back up there. We're well up into the upper end of our +3 channel for the standard deviations chart. So that is suggesting, it could suggest really good momentum because we rode this upper channel here for quite a while, but we were seeing more across the board strength as that was happening. And we were seeing interest rates doing some things at the same time. We'll have to see if the rest of the market can kind of come along for the ride. Intermediate term with the balance of power, we are positive. We're positive with the go, no-go system with the darker blue bar. We shot out above the highest high blue line here, so that is positive, and the midpoint is still going up. The TTM squeeze is shifting back over and looking positive with the lighter shade of blue bar. And we're getting extreme with the boom indicator, showing that we're getting kind of far away from the 20-period and 50-period moving averages. And the 1-day ease of movement, yeah, that's pretty extreme right there. We are looking more positive with the 14-period ease of movement. The Arun did kick up, and we're getting back into getting an extreme positive reading as the green line is going up, and that's pegged at the top. The red line is coming down. That's why we're getting such an extreme positive reading. We did cross above zero with the S&P McClellan oscillator, but we're still concerned about this. We've been going up with the S&P, but we're seeing a negative divergence with the McClellan oscillator. And this has been something that we've been watching for a while now. So we're trying to turn back up based on price, and we're turning up based on volume. So that is positive in and of itself, but we've been pretty choppy with our prices lately. We did climb back above zero with the NYSE McClellan oscillator. So we're starting to turn back up with the summation index based on price as well as volume. And with the Swenlin trading oscillator, we're above zero and advancing based on price. We climbed back above zero based on volume. That's positive. But when you start looking at our oscillators, see, we turned up a little bit, but we're still mostly below the moving average and already giving an extreme positive reading and showing a negative divergence. Really didn't see much of an improvement here, slightly positive based on price, and we're still on top of the moving average based on volume. We did see some improvement with the PMOs that are rising. The buy signals did turn up. We're starting to turn back up after declining with the PMOs above zero. Of course, with the Elders Impulse system, we're positive with the solid up day when looking at the S&P. This is big. The parabolic SAR now has a dot underneath. So that helps establish more of the intermediate term positive outlook. The slope oscillator is turning back up, but it's still below its moving average and is already extreme positive. The MACD hasn't crossed above its moving average yet, so it's still declining. You could also make a case for a longer-term negative divergence here. So looking at all of our oscillators, trying to turn up with the slope and the TSI, but haven't really done that yet. Showing some improvement with the MACD, the PMO, and the PPO, but we're still declining overall, and we're still seeing negative divergences pretty much across the board. We haven't really shifted that much, in fact, really at all. We're looking more negative with the tricks and KST with our longer term oscillators. We're well above all of the plotted moving averages here, and the 20 period has been acting as support. And as long as that was happening, we were just looking at this being a pullback, and then we shot out. Now we have to see, can the rest of the market, as I said before, start to pick up and really justify this price increase that's been happening? But we didn't really see much of an improvement with the bullish percent index with the S&P. You would expect on such a solid update that this would go up more than it did. And we just kind of ticked up a little bit with the NYSE bullish percent index. We did go back up with the NASDAQ 100 bullish percent index. So that's showing some improvement, but we're still below 70 after we had been declining. We ticked up a little bit with the money flow index. We're also going back up with the ultimate oscillator. The vortex did turn back up with the green line on top, so that is positive. And I've tried to shift a little bit of how I present this with the RSI. Usually I try to point out when we're extreme positive or negative, whether we're above or below the midpoint. I want to kind of color code these. You notice earlier in the year when we were really going up, you notice most of the RSI readings were above 50. And then when we hit that problem last summer, most of the RSI readings were below 50. And then we hit the low in October, and now most of the readings are above 50 again, with even some extreme positive readings. So I'm going to try to add that to the overall analysis. We're starting to get a little extreme. We're just on the border right now with our RSI 9 period. We're looking okay and still positive with the on-balance volume. With the rate of change going back 50 periods, we're starting to get extreme again. And this is another area where we're still seeing a negative divergence with our 200 period moving average study and our 50 period moving average study. Yeah, they both went up, but we want to see this going back and really hitting some high levels with both of these indicators as the S&P is making new highs too. And so that's still causing us some concern here. The copy curve has turned up, but is still negative. The Sean trend meter is starting to get extreme positive. And the percent beat, we closed outside of the upper Bollinger Band, and we don't do that very often. So this is also suggesting that we've gone up pretty far, pretty fast. This is another one I wanted to bring up. We are setting new all-time highs with the S&P. We're close, and we were up with the NASDAQ, but we're not setting a new all-time high with the NASDAQ yet. That would help confirm things if that ended up happening, but it hasn't happened yet. Our different charts, then these are based on trends, so they're pretty much positive across the board. The Heiken Ashi is showing a lot of improvement and is positive. The Kegi has turned back up. That's positive. The Renko is still positive. The 3-line break is positive. And we had a new X drawn in with the point and figure chart. We're still working off of the same double top breakout signal that was generated on November 20th, 2023. But anytime we add a new X in here, that is positive. And then here's our trend line study where we were concerned we started to break below this trend line. Well, now we're quite a bit above it. Okay, if we do see some weakness, we'll be watching this again as a possible level of support. If we end up closing down below that, that could shift things more negative in the short term. And then I wanted to keep an eye on this because we're getting kind of close. This is a weekly chart with the pivot points. And because it's been a few days, I usually show this in the weekly video. If you notice that, let me go back here to a good time. Back in 2021, we hit this week. This is actually a monthly pivot point because it's based on a weekly chart. It projects out one time frame ahead. But we hit this upper level, and then that's when we started to really run into trouble in 2022. Then we were humming along last summer, July 2023. We hit this weekly pivot point, and then that's where we ended up going down for a few months. We're getting really close to this R1 level that's at about the 5,110 to 111 level. We're below that right now. And we're what, 13, about 30 points away from that rate. I can't do math all that quick, but keep an eye on us. We're still below it. It looks like we're right there now, but we're not quite at that level yet. Now we could break a little bit above that, but what is going to happen if we start hitting that point? Are we going to see massive selling like we've seen recently, or are we going to be able to break on through and actually get above this pivot point? We are looking extreme with our 150 and 200 period moving average studies, and we're solid green across the board with the Keller market model. When you look at all the different indexes, we were really up. We did see consumer staples. They crossed below 50. That was the only negative thing, but everything else that was done in Thursday's session was positive. The equal weight, it did okay, and it's been doing better lately, but we want to see more follow through. So this is going back up just a little bit, meaning that the mega caps outperformed the rest of the market. And the Dow was able to get above this R1 level and set a new all-time high. That's always a positive thing. And the diamonds are positive with the Elder's Impulse system, but we haven't broken out above this previous high with the NASDAQ yet. And we could be running into some overhead resistance with the previous all-time high because we're getting kind of close to that level. And I wanted to bring up the fib chart as well. This shows that we're a little bit further away with the NASDAQ. But first, we want to take care of this previous all-time high if we keep going up, and then see if we can, there's another high set when we've already gone above that. We want to see if we're able to actually set a new all-time high with the NASDAQ and break through this 100% retracement level. And we did break above R1, but we haven't surpassed this previous high. Now, we did on a closing basis. That's why the NASDAQ 100 is setting a new all-time high, but not on an intraday basis, at least yet. But we've gone from being negative over to positive with the QQQs. When looking at the Elder's Impulse system, we're still negative with momentum, even though we are turning back up. And small caps just kind of hung around a little bit above their 50-day moving average. They've gone from being negative to neutral with the Elder's Impulse system for the small caps, but we're still above this support level. So for right now, that's encouraging when we look at the Russell 2000 small cap ETF, and we're still above the 50-day moving average. The RSI is still above 50. We're coming back down and haven't quite turned back up yet based on momentum. And the mid caps did close above this R2 level. They showed a little more strength. And they've gone from being neutral to positive again with the Elder's Impulse system for the mid caps. The FANG index set another new all-time high, and the financial sector was up and it is still in a solid uptrend. New York Community Bank was up over 2.5% here, where it's been chopping more or less sideways. We're still waiting to see if any more news is going to break out in the banking area. We were up slightly with the dollar, and we're still above both of the moving averages. We were unchanged with the 10-year yield, both based on price, or both based on the yield and based on price. And we're still hanging out above the 200-day moving average here. And then looking at growth to value, we did see some improvement with the Qs to S&P, but we're not quite back up to the moving average, and the moving average has started to decline. Saw a little bit of improvement here with discretionary, breaking out above the moving average, but we need to see the moving average turn back up. We did see some improvement when we compare large cap growth with large cap value. So with the large caps, we saw some improvement, the mid caps, and we did see some improvement with the small caps. What I'm waiting to look for now is just follow through that's more broad based. We're still positive with our 5-period moving average of the highs minus the lows across the broad market. And we're still extreme positive with our 10-day average of the S&P 500 highs minus the lows. And since the S&P outperformed the utilities, we're starting to see this ratio going back up, which is positive for the S&P. So what's our outlook for Friday? We are positive, but we've now developed kind of a long list in the short and intermediate term, and even to an extent the long term, of being overbought or overextended to the upside. Now, that can be a positive thing. When you are riding overbought conditions for a long time, that is usually meaning that the environment is pretty positive. But we're still seeing some weakness that could be developing, and we're also in this period of weak seasonality. We're going to get Okay, I didn't update this. That's a mistake there. We're not going to have any economic reports in Friday's session. And we want to keep an eye on the geopolitical events. Yes, nothing's happening in Friday economically that's being reported. Seasonally, not looking really good for Friday's session. Neutral to negative with the Dow and NASDAQ. Flat out negative with the S&P 500. We are in this period of February now where we typically see some seasonal weakness. This is the longer term look at that same period of time. This could be the area that we're in as far as some weakness is concerned, according to the Stock Traders Almanac. Also weakness when the current president is running for re-election. February is still the worst of the best when you're looking at the 6 months. And Friday does end up being a pretty positive day, not as positive as Monday, but it's the second most positive day of the week, according to what happened in 2023. We do see some seasonal weakness here during an election year for the S&P 500. So that could put a little bit of pressure on things. And then Tom Bowley still has his research suggesting that the last half of February tends to be negative. So our scenarios, not going with the down one, but since we're positive, but we are overbought, there's some of this weakness developing, but we're not really seeing that following through into our charts yet. And we're also dealing with weak seasonality. That's another reason to be somewhat cautious unless we have an up day of establishing any other long positions. Now in Wednesday's session, since we had that nice little run up and we ended up closing positive, you might have opened some long positions right near the close. And then with the gap higher, you were able to ride that in Thursday's session. So that would have ended up working out. But we only want to go with the any up positions if we see strength in the market. And we're not going with the sideways trend for right now because it shows that we are still trending. Volume has usually been decreasing when the S&P moves higher. We've seen a little bit of an exception to that over the last couple of days. We'll see if that ends up changing. The risk-on posture, it's just not moving. And if we were really solid, we would see that risk-on chart really going up. And we're just not seeing that right now. I don't know about the equity put-call ratio since those charts weren't updated. We are a little concerned about our oscillators for the S&P because they're looking better, but they're still below their moving averages. And there's also showing some negative divergences after being extreme positive. We're still seeing this negative divergence between the McClellan oscillators and the summation indexes and the S&P specifically. The Copic curve is still negative. The NASDAQ 100 bullish percent index is still below 70, even though it ticked up. We're still looking negative overall with momentum for the NASDAQ 100. We're still seeing that longer-term negative divergence between the small cap index and the mid cap index and the S&P. Discretionary is still negatively diverging. The transports didn't even show those charts. They really didn't improve all that much. They're negatively diverging from the Dow and S&P, and we're in a period of potential seasonal weakness. At least historically, that is what has happened. So far, growth is holding up, and yeah, we saw some improvements on Thursday, but now we want to see more follow-through here. The parabolic SAR chart has switched back to positive. The S&P oscillators are extreme positive. They're still below their moving averages, but the fact that they're extreme positive is positive in and of itself. The vortex is positive. Small and mid-cap growth so far continues to hold up and showed some improvement. The financial sector continues to be positive. So our conclusion, we're positive, but we're becoming quickly overbought again, which doesn't necessarily mean we have to reverse. We're going to be looking for some area of overhead resistance, possibly that long-term pivot point that we've hit a couple of times over the last couple of years. We're still seeing going with the idea that weakness is still developing, and we're also dealing with weak seasonality. That's pretty much what we're watching in the short term. We're watching more in the intermediate term. Even though the parabolic SAR chart turned back to positive, we're not seeing an awful lot of strength otherwise, and we're still looking extreme positive, but yet positive in the long term. Thank you. I really hope you found this helpful. I hope you have a great day, and I will talk to you in the next video.